So you go to the grocery store, right? You grab a box of infant formula off the shelf and you toss it in your cart.
Yeah, exactly. It's completely automatic.
Right. You don't give a second thought to the expiration date printed on the bottom of that tin. Or, the software that ensured the allergen warning on the back is legally perfectly accurate.
Nobody does. You definitely don't.
And then you go home, you turn on your kitchen tap to mix that formula, and you don't even think about the parts per million of organic compounds flowing out of the faucet. We just assume someone, somewhere, is keeping an eye on it.
Right, it's just expected. We just assume the invisible architecture holding our daily routines together is foolproof.
Exactly. But behind that microscopic precision, behind the ink on the label and the purity of the water, is a multi-billion-dollar industrial machine.
Oh, absolutely. And it is a completely binary expectation.
Yeah.
Safe or not safe. There's no middle ground.
None. And if that machine slips up for even a fraction of a second, a single misprinted word or a single undetected chemical spike doesn't just cost a company a lost sale, it triggers a national health crisis.
Yeah, we demand perfection from the physical infrastructure of our lives, but we remain completely blind to the mechanics of how that perfection is actually guaranteed.
Today, we are tearing apart the financials of the company that essentially builds and maintains that invisible safety net. Welcome to the Deep Dive.
Glad to be here for this one. It's a fascinating company.
Yeah, so today we are doing a talk ticker style breakdown of Veralto Corporation, ticker symbol VLTO. We have their Q4 2025 earnings call transcript, their supplemental financial data, and, a mountain of research on the underlying science of what they actually do spread out right in front of us.
And there is a lot to get through.
There is. And our mission today is simple. We are going to give you a data-forward, fast-paced, and highly opinionated analysis. We're completely stripping away the impenetrable Wall Street jargon to figure out how this machine works and, ultimately, if it deserves a place in your portfolio.
I love that approach because it gets dense quickly.
It does. Okay, so let's unpack this. Who exactly is Veralto?
Well, for anyone who doesn't track the industrial sector on a daily basis, Veralto is a global industrial powerhouse. And they have this really interesting dual-pronged focus.
Right, two main segments.
Exactly. First, they safeguard water quality. They're the ones testing, treating, and analyzing water in municipal plants, oceans, and factories globally.
That's the wet side of the business.
Yeah, the wet side. And second, they focus on what they call product quality and innovation, or PQI.
PQI. Okay, and what does that actually mean in plain English?
In plain English, they ensure that product packaging, coding, and marking are flawless, so that the global supply chain of food, pharmaceuticals, and essential goods remains entirely safe and traceable.
Got it. So capping off 2025 gives us the perfect vantage point to see how they navigated a year that was, it was universally considered a macroeconomic minefield. Let's look at the raw scorecard, starting with the top line. The revenue.
The big numbers.
The big numbers. So in the fourth quarter of 2025, Veralto brought in $1.4 billion. That is up 3.8% year over year.
Which is solid.
It is. But the truly staggering number is the full year. They hit an all-time high for 2025 with $5.5 billion in total sales.
Wow.
Yeah, that is a 6% increase from the prior year.
Putting that 6% into context is crucial for you as an investor.
Why is that? 6% doesn't sound like a software tech boom number.
It doesn't, but in the industrial sector, generating multi-billion-dollar top-line growth in a year marked by volatile interest rates, shifting geopolitical tariffs, and massive supply chain bottlenecks. It is a massive achievement.
Right, because other companies were struggling.
Exactly. You have industrial giants out there fighting just to stay flat. So seeing $5.5 billion come through the front door shows that their end markets are fundamentally resilient.
But, the top line is just vanity. It doesn't matter how much water flows into the bucket if there are holes in the bottom.
So true.
We need to look at how well management is actually running the house, which means looking at the bottom line. So for the fourth quarter, their adjusted earnings per share, the actual profit attributable to each share of stock, came in at $1.04.
Yep, $1.04.
That represents a 9% growth year over year, so their profits are actually growing faster than their revenue.
Which brings us directly to their profitability metrics. Their Q4 adjusted operating profit margin improved by 80 basis points, landing at 24.4%.
Okay, let's hold there.
And for the full year, they delivered about 30% incremental margins.
Let's translate that for the listener, because basis points and incremental margins can sound like a foreign language if you aren't staring at a Bloomberg terminal all day.
Fair point. It's easy to get lost in the jargon.
Right. So when we say an 80 basis point improvement, we mean an improvement of 0.8%. It sounds microscopic.
It does, less than 1%.
Less than 1%. But when you are operating on a scale of $1.4 billion in quarterly revenue, that seemingly tiny efficiency tweak means millions of dollars stop getting chewed up by factory waste or supply chain friction.
Exactly.
And instead, those millions fall straight to the bottom line as pure profit.
That's the beauty of scale.
And that 30% incremental margin. That means for every new additional dollar of revenue they brought in this year, 30 cents of it bypassed the cost of goods sold and went straight to operating profit.
It's incredibly efficient. And they managed to squeeze out that profitability despite absorbing heavy tariff headwinds earlier in the year. Plus, they were pouring money into research and development for a new software platform.
Right. They weren't just starving the business to make the numbers look good.
No, not at all. It proves they aren't just brute forcing their sales, they are engineering their growth really efficiently.
But here is the metric that absolutely stopped me in my tracks when I was reading through this transcript.
Oh, the cash flow.
Yes. Think of a company as a machine that consumes capital to produce cash. In Q4 alone, Veralto generated $291 million in free cash flow.
Just in one quarter.
Just one quarter. And over the full year 2025, they generated over $1 billion in pure free cash flow.
What is truly fascinating about that billion-dollar figure is the conversion rate.
Let's get into that.
Yeah, so that $291 million in the fourth quarter represents a 115% conversion rate of their GAAP net income to free cash flow.
Okay, I have to push back on this, or at least, play devil's advocate for a second.
Sure. Go ahead.
Because to a lot of people, earning $1 of accounting profit and somehow generating $1.15 in cold, hard cash sounds like a math error.
It does sound illegal at first glance.
Right. Like, how do you legally get a 115% conversion rate? Let me see if I can work this out.
Let's hear it.
Okay, so if I own a fleet of rental cars, my accounting profit takes a massive hit every year because those cars are depreciating in value. On paper, I'm losing money as the cars age.
Right. Depreciation is a huge accounting expense.
But in reality, the cars are still out on the road and the customers are handing me physical cash every day. So my cash flow is actually way higher than my paper profit. Is that sort of what's happening here with Veralto?
That is a phenomenal analogy, and it hits the nail right on the head. Net income is a strict accounting metric.
Okay.
It includes non-cash expenses, like the depreciation of their factory equipment, and more importantly for Veralto, the amortization of all the intangible assets from the companies they have acquired over the years.
So writing down the value of old acquisitions.
Exactly. Free cash flow, on the other hand, is the actual physical cash entering the corporate bank account, minus the capital expenditures.
Meaning the physical cash they have to spend on new equipment just to keep the lights on?
Right, because Veralto is essentially a light assembly business. They are building sensors, packaging software, and chemical dosing systems.
Right. They aren't building $10 billion semiconductor foundries or massive steel mills where you have to constantly replace blast furnaces.
Exactly. Their capital expenditure requirements are incredibly tiny. It's only about 1% to 1.5% of their total sales.
Wow, that is low.
It's very low. So when you strip out those heavy non-cash accounting charges for depreciation and amortization, the actual cash they stack up in the vault is significantly higher than their accounting profit.
That makes total sense.
Generating over $1 billion in free cash flow on $5.5 billion in sales makes them a stunningly efficient cash generation machine.
$1 billion in cash is incredible. But, cash flow is a lagging indicator. It tells us what happened yesterday.
Sure.
To understand if that cash printer is going to keep running tomorrow, we need to look under the hood at what actually drove those revenues and see if the engine is starting to sputter.
Okay, where are you going with this?
Because when I look at the segment breakdown, I see a bit of a red flag.
Let's test that theory. Where are you seeing weakness?
Well, Veralto operates in two main segments, like we said. Water quality did $846 million in total sales just in Q4, which is up 4.3%.
Right.
The product quality and innovation segment, PQI, did $550 million in Q4, up 3%.
Still solid numbers.
They are, but when you look at their core sales growth, which strips out currency fluctuations and recent acquisitions to show the true organic health of the business, Q4 core sales only grew 1.6%.
I see what you're looking at.
When you compare that to the full year's 4.7% core growth, 1.6% looks incredibly weak. I mean, they were putting up high single-digit core growth earlier in the year. Did demand just fall off a cliff at the end of 2025?
It is the exact question an analyst would immediately flag.
I'm glad I'm not crazy.
You're not. But if you look closely at the underlying mechanisms driving those factory floors, buried in the CFO's remarks is a massive hidden variable.
Okay, what is it? Q4 of 2025 had 3 fewer shipping days compared to Q4 of the prior year.
Wait, 3 days?
3 days.
You're telling me a billion-dollar industrial powerhouse saw its growth cut in half because the calendar shifted by 3 days?
3 days is an absolute eternity in industrial manufacturing.
That just sounds like an excuse, though.
It sounds like one, but the math backs it up. The CFO, Samir, pointed out that this calendar anomaly effectively wiped out approximately 260 basis points or 2.6% of volume growth across the entire company.
Wow.
If you normalize for those 3 missing days, their core growth would have been well over 4%, landing perfectly in line with their full-year average.
Okay, let me try to break down this calendar math because I think it exposes the bedrock of their entire business model.
Let's do it.
If I own a software consulting business and I close for 3 days, I just do the work the following week. The revenue rolls over.
Even in traditional manufacturing, if a customer orders a massive turbine and the factory is closed for 3 days, that turbine just ships in the next quarter. The revenue isn't lost, it's just delayed.
Right, it just shifts to the right on the timeline.
So why did Veralto permanently lose that 2.6% of volume?
Because of what they sell. This brings us to the razor and blade strategy.
Okay.
Veralto isn't primarily selling massive turbines. They are selling the daily consumables required to run the global economy.
Yeah.
60% of Veralto's total revenue is recurring.
I see. You sell the industrial continuous inkjet printer, the razor handle, at a reasonable price, and you make your incredible margins selling the proprietary ultraviolet curable inks the blades over and over again for the 10-year lifespan of that printer.
Precisely. It's a classic model for a reason.
Yeah.
Consider a municipal water plant.
Okay.
They use specialized chemical treatments from Veralto's ChemTreat business to prevent biofouling.
Biofouling?
Yeah, that's when microbes and algae literally grow inside the pipes and choke the water flow. Or think about a massive food packaging facility, printing expiration dates on thousands of milk cartons an hour. You literally cannot run the packaging machine without Veralto's ink. If the factory is open and producing, it is physically burning through Veralto's consumables.
So if a quarter has 3 fewer working days in it, that's 3 fewer days of factories running globally.
Exactly.
That means 3 fewer days of ink being sprayed, 3 fewer days of biochemicals being dripped into cooling towers, and 3 fewer days of sensors requiring recalibration. The consumption simply didn't happen. The volume is gone. It evaporated.
It vanished. And remember the phrase the CEO, Jennifer Honeycutt, used. These are consumables critical to daily operations where the cost of failure is high.
Cost of failure is high. That's a great phrase.
It explains everything. A brand cannot legally ship a pallet of food without a batch code. A power plant cannot operate its massive cooling towers without treating the water to prevent corrosive scale buildup. The customers are completely captive to the daily consumption of Veralto's products.
I love looking at this through the lens of a biological system. Veralto is essentially providing the immune system for a power plant.
That's a great way to put it.
The plant needs a constant microscopic drip of white blood cells, the chemical treatments to stop a fever, which in this case would be biofouling or corrosion. You can't just pause your immune system for 3 days. You need it continuously.
And that continuous need, that absolute captivity, gives Veralto incredible pricing power. Even with the volume hit from the missing calendar days, their pricing across the company was up 2.3% in Q4.
That is the definition of a wide economic moat.
It really is.
I mean, if you are managing a municipal water supply and your system gets contaminated because you tried to save 2 cents a gallon on a generic, unproven chemical treatment, you are going to be investigated by the EPA and end up on the front page of the national news.
You'll lose your job.
You do not take that risk. The cost of the chemical is a microscopic fraction of the municipality's overall operating budget, but the risk of switching to a cheaper alternative is catastrophic. So when Veralto raises prices by 2.3% to offset inflation, the customers just nod and pay the invoice.
They have no choice. But, a stable base built on captive customers doesn't automatically equal growth.
True.
It raises an important question. If the foundation is just daily replenishment, Where are the actual spikes in new demand coming from?
This is where the earnings transcript got incredibly fascinating to me, because they broke down their end market standouts. They mentioned the usual suspects driving demand, chemical processing facilities, power generation plants, mining operations.
The standard industrial base.
Right. But the one that jumped off the page, the sector that every single investor on the planet is utterly obsessed with right now, was data centers.
The artificial intelligence boom is rippling into the water sector.
And we need to unpack the mechanics of this because it feels like a massive leap.
It does first.
When people think of AI and data centers, they think of semiconductor chips, they think of NVIDIA, they think of massive server racks, they think of the insane electricity demand required to train a large language model.
Power grids, mostly.
Yeah, power grids. How on earth does a relatively boring water testing company fit into the hyper-advanced data center boom?
It all comes down to thermal dynamics.
Okay, explain.
The next generation of AI chips run incredibly dangerously hot. Traditional air conditioning, just blowing cold air down the aisles of a data center is no longer sufficient.
It's just not enough to cool them.
It cannot keep these high-density servers from literally melting themselves into slag. So the entire tech industry is rapidly shifting to liquid cooling.
Okay, let me stop you there because I want to test this thesis.
All right.
Liquid cooling uses a closed-loop system, right? The fluid circulates, absorbs the heat, goes to a heat exchanger, cools down, and circulates back.
That's the basic mechanic.
It actually uses significantly less overall water than a massive traditional evaporative cooling tower blowing steam into the sky.
Yes, it does.
So wouldn't a widespread shift to liquid cooling actually be bad for a water treatment company? Less water volume means less surface area to treat, which means fewer chemicals sold, right?
You would naturally think so. In fact, an analyst on the call asked exactly that question.
Oh, really?
Yeah, but the CEO explained why this transition is actually a massive margin tailwind for Veralto. You are correct that liquid cooling uses a smaller volume of water.
Right.
But that water has to be ultra-high purity.
Define ultra-high purity in this context.
We are talking about water that is running through microscopic channels directly over millions of dollars of incredibly sensitive electronics.
Okay, that sounds stressful.
In a traditional massive cooling tower, a tiny bit of mineral buildup or a small fluctuation in pH is manageable. But in a liquid-cooled AI server, a single speck of calcium carbonate scale or a microscopic bloom of biological matter can clog a microchannel cold plate.
And if that channel clogs?
If that channel clogs, the cooling stops. If the cooling stops, a $40,000 AI chip burns itself out in seconds.
Oh, wow.
You cannot have scale, you cannot have biological growth, and above all, you cannot have galvanic corrosion eating away at the metals in the loop.
So it completely shifts the paradigm. It's no longer about treating massive quantities of water. It's about the microscopic precision of the water.
Exactly. As the CEO put it, it becomes more valuable water.
More valuable water. That makes total sense.
It requires highly complex precision chemical dosing from Veralto's ChemTreat business to maintain the exact chemical equilibrium needed to prevent corrosion.
So they're selling the specialized chemical.
Yes. And it requires continuous real-time monitoring of ultra-low-range organics using their Hatch analytical instruments.
The sensors.
The sensors. It requires high-purity disinfection systems from their Trojan Technologies brand. The smaller the volume of water you use in these high-stakes environments, the higher the need for obsessive microscopic precision. You're essentially treating and testing every single drop.
That is a phenomenal mechanical insight. It takes a volume-based commodity business and turns it into a high-margin precision engineering business.
That's exactly what's happening.
It's the ultimate picks and shovels play for the modern era. You don't have to take on the massive technological risk of trying to invent a faster AI chip than NVIDIA. You just sell the ultra-pure water chemistry that physically allows the NVIDIA chips to exist without catching fire.
And that technological leverage isn't just happening in the water quality segment. We also need to look at the other side of the house, the PQI segment, product quality and innovation.
Let's shift gears to that.
Because Veralto is leaning heavily into AI there too, but solving a completely different kind of disaster.
This was the packaging and coding side. They highlighted a software platform they recently acquired called TraceGains.
Yes, TraceGains.
which grew its sales by over 20% in its first full year under Veralto's ownership. That's huge.
It is.
They are pairing this Trace Gains platform with their existing ESCO software business.
What is critical to understand here is the specific, terrifying pain point they are solving for consumer packaged goods companies, what the industry calls CPG brands. Veralto launched a new AI-enabled solution called Comply AI. To understand why this matters, you have to look at the regulatory minefield these brands operate in.
Let's build a scenario. Let's say a major food brand designs a new label for a peanut butter protein bar. They're selling this bar globally. Historically, how does that label get approved?
Historically, it is a shockingly manual process.
Like humans reading it.
Yes. A graphic designer creates the visual layout. Then, a team of regulatory compliance officers has to manually verify that the design meets the strict legal requirements for every country it will be sold in.
That sounds incredibly tedious.
They have to cross-reference the ingredient list against the FDA Food Safety Modernization Act databases. They have to ensure the allergen warnings like contains peanuts or processed in a facility that uses soy are in the exact legally mandated font size and placement.
And humans, no matter how diligent, eventually suffer from fatigue. They make mistakes.
They do.
A transcription error on an allergen label, say, accidentally omitting the word soy on a tiny run of wrappers, isn't just a minor oops that gets fixed on the next print run.
No, it is not.
It triggers a legally mandated multi-million-dollar Class I product recall.
Precisely.
Yeah.
A recall involves pulling millions of physical products off of grocery store shelves nationwide, destroying them, managing the massive public relations fallout, and facing potential lawsuits if someone suffered an allergic reaction.
It is a nightmare scenario for a brand.
So how does Comply AI actually fix this dynamically?
Yeah, how does the AI step in?
Comply AI automatically cross-references the digital label design with vast, constantly updated global regulatory databases. Instantly. It arrow-proofs the packaging print during the digital design phase before a single physical label is ever sent to a printer.
Wow.
It uses AI to scan the artwork, read the text, and instantly flag if an allergen warning is missing, if an ingredient list doesn't match the formulation, or if a nutritional claim violates a regional law.
It drastically accelerates the time to market for new products because you aren't waiting weeks for legal teams to manually proofread packaging.
Exactly.
But more importantly, it acts as a digital insurance policy against those devastating recalls. It is another perfect example of that cost of failure is high dynamic.
Right back to that core thesis.
A massive food conglomerate will gladly pay Veralto a recurring high-margin software subscription fee if it means they can virtually eliminate the risk of a multi-million-dollar recall caused by a typo.
But Veralto's management isn't just relying on organic growth from their existing portfolio. They are aggressively shaping the structure of the company through mergers and acquisitions.
They are essentially pruning the dead weight and grafting on high-growth branches.
That's a good way to put it.
Early in 2025, they divested AVT, which was a slower growth product line within the PQI segment. They simply sold it off because it wasn't meeting their internal margin target.
They're very disciplined about that.
But the move that really signals their strategic direction was an acquisition they closed just a few weeks into 2026.
The acquisition of a company called In-Situ.
I really want to break this deal down because I think it perfectly illustrates exactly how dominant Veralto's position is.
Let's do it.
In-Situ is based in Colorado. They are a global leader in environmental water analytics. They design and manufacture the physical sensors and the data management solutions that monitor surface water and groundwater.
Notice the shift in environment there.
What do you mean?
Well, Veralto's traditional strength has been inside the walls of the municipal treatment plant or inside the industrial factory.
Oh, right. Captive environments.
Yes. In-Situ takes them outside, into the wild environment, rivers, aquifers, coastal waters, and agricultural runoff.
Why is that environmental space suddenly so valuable? Why buy a company focused on groundwater?
It is driven by macro-regulatory trends. As climate change exacerbates water scarcity and drought conditions globally, governments are being forced to heavily regulate how much water is being pulled from underground aquifers.
That makes sense.
Furthermore, the EPA is cracking down intensely on environmental contaminants like PFAS, the so-called forever chemicals leaching into rivers and streams.
Russ, you hear about PFAS everywhere now.
And you cannot regulate what you cannot measure. Governments and agricultural conglomerates are suddenly being mandated to deploy thousands of remote, highly accurate sensors into the environment to monitor water health in real time.
And the financials of In-Situ reflect that massive demand spike. They generated about $80 million in sales in 2025.
Which is a nice chunk of change.
And they have historically grown at roughly 8% organically, which is significantly faster than Veralto's core growth average of 4.7%.
It elevates the whole company's growth profile.
Exactly. They have gross margins hovering around 50% and solid EBITDA margins in the mid-teens.
But the real synergy, the reason Veralto targeted them specifically, is how In-Situ's product line perfectly snaps together with an existing Veralto brand called OTT Hydromet.
Explain the difference between what those two brands do, because they sound identical at first glance.
They do, but there's a key distinction. OTT Hydromet is a legacy Veralto brand that specializes in measuring water quantity in the environment.
Quantity? Like how much water?
Right. They build the rugged sensors that measure the physical water level in a reservoir or the flow velocity of a river to predict flooding.
Okay, got it.
In-Situ, on the other hand, specializes in measuring water quality. They build the advanced electrochemical sensors that detect dissolved oxygen, pH levels, and specific chemical contaminants in that exact same river.
Oh, that is a brilliant integration. Think about the municipal bidding process.
Oh, it changes everything.
If I am a government agency managing a massive river basin, I have to monitor both flood risks and chemical spills. Historically, I had to run a complex procurement process to buy the physical flow sensors from Veralto and then run a separate bid to buy the chemical sensors from In-Situ.
And then deal with two different vendors.
And then pay an IT contractor to try to force the two different software dashboards to talk to each other.
Exactly. Now, Veralto walks into that government procurement office and says, we have the entire environmental monitoring ecosystem, quantity and quality, physical and chemical, integrated into a single, seamless hardware and software package.
It is an instant, massive competitive advantage.
Plus, there's a massive geographic synergy.
How so?
In-Situ has been predominantly a North American company. They simply didn't have the scale to build out massive sales teams in Europe or Asia.
Ah, but Veralto does.
Veralto has an entrenched global sales force. They can immediately take In-Situ sensors and push them through their existing distribution channels in Latin America, Europe, and the Asia-Pacific region.
And here is the true flex regarding this acquisition. Look at how they funded it. The net cash outflow was $427 million. They bought the entire company outright. But they didn't have to go to the bond market and borrow money at 6% or 7% interest rates. They didn't have to dilute their existing shareholders by issuing millions of new shares of stock.
No, they didn't.
They just reached into that giant free cash flow vault we talked about earlier, pulled out $427 million of their own money, and bought an $80 million fast-growing company.
It is a stunning display of financial power.
It really is. But, knowing what happened in 2025 and understanding the strategic logic of the In-Situ deal only tells us where they have been.
Right, the rearview mirror.
The stock market is a forward-looking discounting mechanism. The market only cares about what you're going to do tomorrow, which means we need to deeply analyze management guidance. What is Veralto actually signaling for 2026?
Okay, let's get into the guidance. On the top line, management is guiding for core sales growth in the low to mid single digits.
When you factor in foreign exchange tailwinds and the M&A revenue contribution from In-Situ, total sales are expected to grow in the mid to high single digits.
Yep.
And for the bottom line, they are forecasting adjusted earnings per share in the range of $4.10 to $4.20.
When you read the Q&A section of the earnings call transcript, you can actively feel the Wall Street analysts trying to poke holes in this guidance.
They always do.
One analyst essentially challenged the CFO, pointing out that Veralto is projecting double-digit EPS growth, yet their top-line revenue guide is only low to mid-single digits.
Right. There's a disconnect there.
The analyst asked what was giving management pause on the revenue side.
It was a very polite way of the analyst asking, why are you sandbagging your revenue numbers? We know the business is stronger than this.
Precisely. And the CFO, Samir, gave a very deliberate, carefully worded answer.
What did she say?
He said, I think it just makes sense for us to be prudent. There's still some moving parts from the macro perspective.
Prudent. That's the magic word. We don't need to dumb this down, but we do need to decode the corporate spin here.
Please do.
When a chief financial officer tells a room full of analysts that Q1 orders are already strong, but they are issuing a judicious full-year guide because of vague macro moving parts, they're executing the classic Wall Street expectation management playbook.
Underpromise and overdeliver.
Exactly. They are intentionally underpromising so they can look like absolute heroes when they overdeliver later in the year. If you guide for 8% growth and you only hit 7%, the market punishes your stock.
Brutally.
If you guide for 4% and you hit 6%, the stock pops. Veralto is setting a bar they know they can comfortably clear, setting themselves up for a series of beat and raise quarters throughout 2026.
And while the top-line guide might be conservative, they were remarkably specific about the margin math for 2026. And the mechanics of this are crucial for investors to grasp.
Okay, lay out the margin math.
The core business is incredibly healthy. They explicitly expect 50 basis points of core margin expansion in 2026.
That is another 0.5% of total revenue falling directly to the bottom line as pure profit. How do they physically achieve that in an inflationary environment?
It is heavily driven by expected pricing power of 150 to 200 basis points.
So raising prices.
Yes, they have the pricing leverage to continue raising rates on their captive customers to offset any raw material inflation. Additionally, the severe friction from geopolitical tariffs that drag down their margins in early 2025 is expected to completely roll off the income statement by the second half of 2026.
But wait, let me look at these numbers again.
Sure.
If the core margin is expanding by 50 basis points due to pricing power and fading tariffs, why is the total company margin guidance only projecting a 25 basis point improvement? Where did the other half of that profitability go?
It gets temporarily swallowed by the In-Situ acquisition. Whenever a massive public company buys a smaller, privately held company, there are immediate heavy integration costs. You have to migrate their entire workforce onto your IT infrastructure and cybersecurity networks.
Which is never cheap.
Never. You have to align their accounting practices with public company Sarbanes-Oxley standards. You might consolidate their factory floor space or pay severance to redundant middle management.
Right.
All of those upfront friction costs mean the In-Situ deal will cause a temporary 25 basis point mathematical dilution to Veralto's overall margin in year one.
Okay. That makes complete mechanical sense. The core engine is running hotter and more efficiently than ever, but the overall vehicle takes a slight aerodynamic drag while they bolt on the new, fast-growing engine part.
That's a perfect analogy. And there's one more highly technical but critical detail that investors must understand about how this all-cash deal impacts their earnings.
Hit me with it.
The CFO specifically noted that the In-Situ acquisition will actually dilute 2026 EPS by about 4 cents.
I'm going to stop you right there because that sounds completely backwards.
I know it does.
How does acquiring an incredibly healthy company, one that generates $80 million in sales and has mid-teen EBITDA margins, actually reduce your earnings per share?
It is an accounting quirk related purely to how they funded the transaction.
Right.
Remember, they used $427 million of their own cash.
Right.
When that cash was sitting securely in Veralto's corporate bank accounts, it wasn't just gathering dust, it was earning interest. Let's assume they had it parked in a conservative money market fund yielding 5%.
Okay, let me do the math on that. 5% of $427 million, that is roughly $21 million a year in pure risk-free interest income.
Exactly. When Veralto wires that $427 million to the founders of In-Situ to close the deal, that $21 million of risk-free interest income instantly vanishes from Veralto's income statement.
Oh, I see.
The operating profit that In-Situ will generate in its first year of integration under Veralto won't be quite enough to fully offset the immediate loss of that $21 million in interest income. Therefore, you get a 4-cent mathematical headwind to EPS.
That is a brilliant nuance to decode. It isn't that In-Situ is a flawed business. It is simply an interest rate swap.
Exactly, a swap.
That cash was earning a fantastic zero-effort return, and management strategically swapped it for a long-term, high-growth environmental asset. In years 2 and 3, as they recognize those top-line synergies we discussed and pump In-Situ sensors through their global channels, that deal will become wildly accretive to earnings.
Absolutely.
But in year 1, it acts as a slight mathematical drag.
Which brings us to the ultimate question. We have torn apart the raw financials, we have broken down the calendar anomalies and the liquid cooling AI tailwinds, and we have decoded management's conservative guidance and M&A accounting.
The whole picture.
So what is the final verdict?
We have to synthesize all of this and take a concrete position. For the investor sitting at home, looking at their portfolio allocation, what do they actually do with VLTO? Is this a buy, hold, or sell?
After analyzing the underlying mechanics of their growth, my stance is resolutely bullish.
Okay, bullish.
However, I want to add a massive caveat. This thesis is exclusively for the long-term, defense-oriented investor. This is an industrial compounder. It is not going to double in a week based on a social media trend.
I'm going to push back on the thesis just slightly.
Go for it.
I agree the business is phenomenal, but isn't it priced for perfection? Why buy a boring water and packaging company when there are tech stocks putting up 40% top-line growth?
Because of the asymmetry of risk.
Tell me more.
Tech stocks can lose their competitive moat overnight if a competitor launches a faster chip or a better algorithm. Veralto's moat is entrenched in physical, daily, municipal, and industrial operations.
The stuff that has to happen every single day.
Exactly. And more importantly, my bullishness is anchored in one absolute, undeniable truth in the stock market. The ultimate flex of a healthy company is how it strategically allocates its capital back to its shareholders.
You're talking about the buybacks and the dividend.
Exactly. Corporate guidance is just an educated guess. Executive talk is cheap. But a company's physical capital allocation tells you exactly, mathematically, what the board of directors truly believes about the internal health of the business.
Right, they have to put their money where their mouth is.
And at the end of 2025, Veralto's board authorized a massive $750 million share repurchase program.
So they are stepping into the open market and buying their own stock, reducing the total supply of shares, which inherently makes every remaining share more valuable.
Yep. And simultaneously, they hiked their quarterly dividend by an astonishing 18%.
That is the ultimate signal of confidence. You absolutely do not hike your dividend by nearly 20%, permanently increasing your mandatory cash outflow to shareholders quarter after quarter, year after year, unless your financial forecasting models show absolute ironclad certainty in the durability of your future cash flows.
You just don't do it.
A company will do almost anything to avoid cutting a dividend once it's raised, so raising it by 18% means they know that cash printer is never going to jam.
And their balance sheet gives them the absolute operational freedom to execute this strategy. This is what financial analysts refer to as a fortress balance sheet.
Let's look at that balance sheet.
Even after spending $427 million in cold cash to buy In-Situ, Veralto's net debt leverage is sitting at roughly 0.5 times.
Explain what 0.5 times net leverage practically means to a bank or an investor evaluating their risk.
Leverage is simply the ratio of a company's total debt minus its cash, compared to its annual earnings before interest, taxes, depreciation, and amortization. It's EBITDA.
Right.
If a company has $500 million in debt and generates $100 million in earnings, it has a leverage ratio of 5 times. That is highly leveraged. They're carrying a lot of debt relative to their income.
Okay.
Veralto's leverage is 0.5 times. I mean, their net debt is only half of what they earn in a single year.
For a massive industrial company with 60% recurring revenue, that is virtually unlevered. They had nearly $2 billion in cash on hand before the In-Situ deal. They are operating with extreme financial conservatism.
Which means they have endless dry powder. They are operating in highly fragmented markets. There are dozens, if not hundreds, of small, $50 million to $100 million private companies specializing in niche water analytics or specialized packaging software.
Just waiting to be scooped up.
Exactly. Veralto can sit back, patiently watch the macro environment, and whenever they identify a strategic technological fit, they can just stroke a check. They don't need a bank's permission, and they aren't held hostage by rising interest rates in the credit markets.
They are essentially operating as their own internal private equity firm. They roll up these specialized fragmented industries, and then they strip out the operational inefficiencies using their proprietary management framework, the Veralto Enterprise System.
The Veralto Enterprise System, or VES, is truly the secret sauce that makes this entire conglomerate function.
It's what makes the machine hum.
It is a deeply ingrained corporate culture of lean manufacturing and continuous, relentless operational improvement. We saw VES in action when the CEO discussed how they regionalized their supply chain in 2025.
Right. When geopolitical tensions and tariffs threatened their margins, they didn't panic and issue profit warnings. They relied on the fact that they are a capital-light assembly business.
You just move.
They seamlessly kitted up over a dozen production lines and physically moved them across the globe to optimize their tax and tariff footprints. They moved Videojet manufacturing out of China and into the UK.
Yep.
They aggressively expanded Trojan Technologies manufacturing in the U.S. to de-risk their reliance on Canadian facilities. As the CEO pointed out, these are no-regret moves that ensure maximum agility.
So when you synthesize all of these data points, the fortress balance sheet, the agile supply chain, the massive free cash flow conversion, and the 60% recurring revenue, it paints a very clear picture.
If you are building a resilient portfolio, this is the ultimate sleep well at night thesis. Think about the economic insulation this company possesses. 80% of their total sales are tied directly to non-discretionary essential goods.
You can't skip them.
They secure the global water supply, and they ensure the legal compliance of the global food supply. You can have a severe economic recession. You can have a massive spike in federal interest rates. You can have a geopolitical crisis in Europe or Asia.
People will still turn on their taps to drink water, and they will still go to the grocery store to buy infant formula. The underlying consumption never stops.
And layer on top of that structural resilience the fact that the vast majority of their revenue is driven by recurring consumables, the ultraviolet inks, the precision chemical treatments, the regulatory software subscriptions.
The razor blades.
The razor blades. They are not waiting around holding their breath, hoping a municipality decides to pass a bond measure to make a massive discretionary capital expenditure on a new water plant.
No, they are collecting a toll every single day that the existing plants operate. They are essentially a vital public utility cleverly disguised as an industrial manufacturer.
They are fundamentally insulated from the wild, cyclical economic swings that decimate traditional industrial stocks.
So what does this deep dive mean for you as an investor?
It means Veralto is a defensive powerhouse with hidden explosive growth optionality. You buy the stock for the absolute safety of the municipal water contracts and the FDA food packaging regulations.
Right.
You hold it for the relentless margin expansion driven by the Veralto Enterprise System, the massive share buybacks, and the 18% annual dividend hikes.
Exactly.
But you get the upside of massive secular megatrends like the proliferation of complex consumer packaged goods and the global regulatory crackdown on environmental water quality thrown in for free.
And that brings me to a final provocative thought that I want to leave the listener with today. We touched on this concept earlier, but I really want you to explore the mechanics of this on your own.
Let's hear it.
Right now, every retail investor, every hedge fund manager, and every major institution is rushing headlong to buy semiconductor stocks, server manufacturers, and energy companies to capitalize on the artificial intelligence boom.
It's a gold rush.
But we know with absolute certainty that these next-generation AI servers run incredibly hot. The physics dictate that liquid cooling isn't just an experimental option anymore. It is rapidly becoming the mandatory, non-negotiable standard for data centers globally.
You physically cannot run the chips at full capacity without the liquid loops absorbing the heat.
And you cannot run the liquid loops without absolute microscopic chemical perfection, or you will corrode and destroy billions of dollars of computing infrastructure in a matter of weeks.
Wow.
So here is the question to mull over. As the AI revolution physically scales up across the globe, requiring millions of gallons of perfectly monitored, ultra-pure, chemically balanced water, could a seemingly boring water testing and chemical dosing company like Veralto actually be one of the safest, most lucrative, hidden backdoor plays on the entire AI boom?
That's fascinating.
You don't have to guess which tech CEO is going to design the best microchip next year. You just apply the chemical perfection required to keep all their data centers from melting down.
That is a brilliant reframe of the entire industrial sector. It completely changes how you look at a utility-style company.
It really does.
It turns out the most exciting investments aren't always the ones with the flashiest ticker symbols, the most charismatic founders, or the wildest daily price swings on Wall Street.
Usually they aren't.
Sometimes the absolute best investments are the ones quietly, efficiently running the invisible architecture of the world. They are hidden in plain sight, or in this specific case, hidden in a glass of perfectly clean water.
Well said.
Thank you so much for joining us on this deep dive into Veralto's Q4 earnings. We'll catch you next time.